Now for today's talk. A few months ago, Chris DiGiorgio mentioned that he was involved in a study of the state of the VC industry and its impact on jobs and so forth. And I said, well, that sounds like something we should spread the news about and learn about. And so here we are with our panel. Now, we got a great panel, and if I did complete justice to the introduction, you wouldn't have much of a panel, you just have introductions. So I'm going to be quick, but Chris will lead off, and he's the Executive Research Fellow of the Accenture Institute for High Performance. Before joining the Institute, he had the responsibility for Accenture's overall practice in the Bay Area and as the Managing Director of over 2,300 professionals. And he previously led the high-tech practice in Silicon Valley at Accenture and also its emphasis on emerging technology. He'll be followed by Dixon Dahl. And Dixon Dahl is a well-known venture capitalist. In fact, he was named by Forbes magazine as one of the top 100 venture investors on its so-called Midas list. And he got that distinction 4 years in a row. He also was elected to the board of directors of the National Venture Capital Association, an organization that he chaired in 2008-2009. He also was on its executive committee for 3 years. While serving as chair of the NVCA, he authored a seminal plan to enhance liquidity in the VC industry. Some of the aspects of that plan that he authored were wrapped into the Jobs Act, which was enacted in 2012. And he's on the board of directors of DirecTV, but most importantly, he's on the advisory board of SIEPR. And then Mike McCaffery will be our third panelist, and he is the co-founder and chief executive officer of McKenna Capital. From September 2000 to June 2006, he was president and CEO of the Stanford Management Company, responsible for the investment allocation and the investment choices made by Stanford for its endowment. Prior to leading the Stanford Management Company, he was chairman and chief executive officer of Robertson Stevenson Company, a San Francisco-based investment bank and investment management firm. So we have a great panel. They're going to kind of speak in order. We'll leave time for you to have some questions. Maybe I'll ask a question or two and then turn it over to you. So here we go, guys, and Chris, you go first.
Great, thanks. Well, thanks for that introduction, and it's a pleasure to be here. I've been to a few SIEPR events over the last few years and just joined as a member myself. And if I got the formula right for a successful event, I should start off with a worrisome, depressing report title. I should follow that with slides that detail how it's even worse than that. And then I should make some idealistic recommendations at the end that will never be implemented. Is that how it works? All right, so then we're in good shape. So as I said, I got into this as not as a venture capital person, but as someone who's been in the industry out here for 35 years working, and I thought I really knew how the Valley worked, and I knew what Silicon Valley was about and what venture capital was. But then I got a call from Ray Rothrock over here, who was the head of NVCA, and said, could we help facilitate some dinners that looked at the future of the industry? Because it felt like the VCs were at a sea change, and the world was changing more than just iterations in the past. This was something that was going to be pretty dramatic for many years. So we did a number of dinners around the country. And at the same time, we were working on some research in Silicon Valley for the Institute with my co-author, Jeannie Harris, here. And so we put those together, and we came out with a report titled, If Venture Capital Falters, Will Job Creation Fade? So if venture capital falters, will job creation fade? So what we tried to do was take a database look, a fact-based look at the impact of venture capital on jobs. We know the impact on financials, but what's the impact on jobs? So I'm going to take you through 2 pieces today. One is a bit back on the education of what venture capital is and make sure we're all grounded on that and what's been happening. The second one is we'll talk about what are some of the major issues facing the industry. So as we said here, we looked at this from a research point of view and tried to decide what has been the impact, what's happening, what are the dynamics going on in the industry, how many of them are short-term, and what are some of the long-term dynamics, and what does that really mean from a job creation and really the social society and the economic impact on this region. So to do that, we found out that most people think they know the VC industry, but they really don't. And this is a graphic we put together that those little black figures climbing out of the primordial ooze of creation and innovation are startups. And this shows that there are some 20,000 new startups a year, about 2,000 get to industrial grade quality, and so on as they march up the hill to IPO, and it all flows back down around again. And there's a lot of details on that. But this was helpful for us to educate broad-based folks who are our audience here on how this place really works. And it's also a catchy graphic, so if you want a poster of this on the way out, you can pick it up. But it does try and summarize, the unique culture we have around here. The other thing we had to do was to level set on what a venture capitalist does. And we talked to a lot of entrepreneurs and a lot of people in the business. Not all of them were cynical about venture capital. A lot of them really liked the VCs. And we said, what do they do on their best day? Besides the cash, what do they bring into the table? So two big piles: expertise and how to start, how to do a business plan, how to scale, how to make arrangements, how to do legal protection. And the other piece is pretty key these days, is to how to get resources, how to find the right top talent in a talent-scarce market. So when we think about the best VCs out there, they should be doing these things. The other aspect we note is that, borrowing some slides from the NVCA, is that the VCs have been around for 40 years and have created not only some great companies, but whole industries by the thousands. So as you see on this chart, 4,500 healthcare companies, over 17,000 IT companies, and 900 or so clean tech. And what's important about this is not that all those companies are still around, because a lot of them aren't, but there's a lot of attempts, and a lot of what Ray calls shots on goal. There's a lot of attempts to try and find the right way to solve this problem. And these are high-risk endeavors, and these are the ones that come out of these industries over time, and we've all enjoyed them. In fact, we've enjoyed them so much that if you look at this chart, you'll see the percentage of jobs in those industries that came from venture-backed companies. In particular, 90% of all software companies are venture-backed, and you can see on down the list from biotech to semiconductor, et cetera. So VCs have proven their worth in creating industries and creating companies that create a lot of jobs, if they can get to the IPO, if they can get out to the exit point where a lot of things happen. So I compared this with some data I picked up from the Bay Area Council Economic Institute, and they were looking at two things. So we know that the tech jobs are very valuable in the economy. They recently calculated these numbers here, which is that a tech worker has got about a 27% premium over the average worker in an economy. So they're paid more, and this is even after equalizing for location differences. So that's a nice significant premium. They have more disposable income, they'll spend more, they'll do more in the economy. But the bigger impact, I think, is on the other chart, which is that the tech job generates 4.5 residual jobs in the community, 3 times the rate of a manufacturing job. So I did a little digging as to what's going on here. Are they hiring a lot more professional services because they're lazy? Are they doing a lot of things? But the reality is a tech worker is using a lot more technology services. They're everything from transportation to food service to other technical support. So the reality is a tech job is worth a lot, not only in salary, but in the residual value in the community. I think we see that today. As we see a surge in the economy out here, we see a lot more traffic and a lot more pickup. So the other thing, and then we look at some of the problems that are occurring. So in this chart, it was simple, which was that we asked entrepreneurs, why are you looking to VCs? What are you doing? Well, for 2 aspects. One is, I need help to build my product, and the other one is, I need help to get my product to market. But what's happened over the last 15 years for various reasons is that they have become easier to build your product because you can do cloud and offshore and development, especially in web apps, and it's easier to get to market because there are platform services out there that you can launch tonight. Some smart student here could probably write an app tonight and have 10,000 customers by tomorrow morning. That clearly wasn't the case. So what's happening with VCs is they're getting involved later in the game. And that there's some good to that, which is you miss out on all the ones that are bad ideas, but the bad news is it changes the economics. But the world of the economics is changing too. So here we see a generalized model that says in the old days you would get in early, you put your $2 million down, you get 20% of the company, and 8 or 10 years later you get your 20x out, right? That's how easy it is? Okay. So what's happening now is, as you see on the bottom, new entrants are coming in. Angels are pretty prominent. People can self-fund their companies. Corporate ventures are coming involved in large numbers. I would add crowdfunding to this most recently in the beginning. And then in the middle, you've got growth equity, who are sort of waiting for those who look pretty good, picking them up, becoming the investors in the middle. And on the back end, you've got private equity coming in and picking up those companies that are growing well, but maybe not good enough for IPO and coming in. So the world has gotten more complicated for funding options for these companies. So let me look at what's happening here. We see how big is the industry. And we see this is a cycle over the last 20 years. And you can see just how crazy things got, if you forgot that. Things got pretty crazy. But it's settled in to be about a $27 billion, $25 to $30 billion new money going in industry, and that's about the size we're at today. It was larger in the past, and maybe maybe it's the right size or not. We'll debate that later today. Well, one of the issues is that the funds, which were initially set to be 8 to 10 years, are now on average 70% or more than 13 years old. So some would say this is part of the overhang, or really the hangover, of the dot-com era, which is still with us. There's a lot of companies in their portfolios who are, again, performing okay, not good enough to IPO, not attractive enough to be purchased, but still hanging around that are really extending the life of these funds. And while that's good for cash flow, it isn't good for the investor funds who need them out to make higher returns, and the VCs who really need to be spending their time on the new companies that can grow faster. What's interesting statistic here is that there's a pretty consistent 1,000 to 1,500 new companies a year, period. So give or take that crazy time back there. And if you went back before this chart to the mid-'80s, it would be the same. So we seem to have settled on about 1,200 or so new companies can be formed, quality companies each year. And we haven't been able to sort of break that level. So one of the things we'll talk about recommendations is what can we do to generate more entrepreneurs with viable ideas that are industrial strength that can make it down to life, because we seem to be stuck at about 1,200. And then liquidity is the challenge here. It's been a difficult IPO market. You don't need to know that. If you just look at the charts in the middle, they went almost to zero. That's pretty dramatic. And as you remember, that back on the VC model, they need the IPO to happen, because that's the big payoff back to the investors. It frees up the capital, it frees up the VCs, and it gets it all going. And I would also add that it's about 90% of all jobs in IPO happen after the IPO. So we need this to happen to generate the jobs we talked about earlier. But they're not happening. Sometimes last year you'll see a big spike there. Of that 20 billion, 16 of it was Facebook, one stock. Of the year before, it would be a Groupon or a LinkedIn. So we really have still a pretty anemic IPO market. Even though the count is up this year, they're still relatively small. So we've got some issues here on regulatory stuff. And the time to get out is taking longer. So you could do this in 5 years. It's creeping up past 7 or 8, as you can see here. So what's happening? M&A has become the primary exit. So most of the time when you want to get out, you go to be acquired. Nothing inherently wrong with being acquired. It's all a matter of proportion. But the reality is when you get acquired, you generally get a lower multiple, and you don't usually get the job growth that comes afterwards. They absorb the assets and some of the people, and we don't get the job growth later. So the right balance of M&A is what really needed here. And finally, we look at the returns. So over this period of time, and I just updated this for the end of June, so the latest data, it's gotten a little bit better, but I would say over the 10-year period, which is sort of the life of a fund, it's about the same as the stock market. You would say that's not all that bad, except that it's a lot riskier and it's totally illiquid. And this is certainly not what the investors were looking for. So there's a problem here with all this put together, where that the funds, again, this is the industry as a whole, have not been that attractive. So in recap here, I'll just recap the 5 points. Are we depressed yet? Are we good? That's my job. Okay, so it's going to be, these guys are going to lift you up, but right now I'm going to try to set reality here. Disappointing returns, new funding options, plateau growth for new starts, as we talked about here. Declining IPOs in general. Maybe this year's a little bit of an anomaly. We'll see if this shakes out. And then one interesting thing here on fewer actively investing VCs. So there's about 500 or 600 VC firms these days. About 20% of them made a new investment last year. So 80% were managing what they've already done, or they're essentially managing the portfolio from a long time ago. So I think with that backdrop, what I wanted to do was set the stage to help educate you a little bit on how the VC industry worked from an outsider's point of view, and set some sobering facts out there that says maybe the industry is shrinking and there's some issues. So questions we ask is, are we the right size now, or maybe we're too small? As the IPO process can be repaired so it can help fix the revenue generation as well as the job creation. Are these new funding sources just as good at creating long-lasting enterprises, or are they really just helping get started, but they don't have a way to make them succeed? And what do we do with society with respect to a smaller industry? So with that, let me turn it over to Dixon, who's going to take you through his point of view. Thank you.
Thanks. Thank you very much. It's a pleasure for me to be here, and one of the things that makes the opportunity to present to a group like this is that you have to really dig deep to come up with a few things that many of the people in here don't already know. So I tried to do that, and I hope that that I can be complimentary. I'm going to take a slightly different position, or maybe a significantly different position on some of these issues that were discussed in the report here. And I also wanted to acknowledge that there's another person here, Ray Rothrock, who followed me a couple of years later as the chairman of the NVCA and got this study going last year on, the fundamental grassroots issues that the venture industry needs to, to grapple with in order to return to its glory days. So I'm going to start out here with a couple of bullet points that I think are fairly important to keep in perspective and things that have not yet been mentioned. First of all, I don't think there's ever been an industry that's more cyclical than the venture capital industry is. I mean, it was founded right here in the Valley, as everybody knows, back in the middle 70s, and I think we have our 40th anniversary this year. Mine was, we celebrated the 35th. We've been through cycles, and you can have a debate about how long cycles are, but nobody debates the fact that that the industry goes through these cycles, and the most extreme example of that was the bubble of '99 and 2000. But back before that, right around the time when I came into the industry, there was a big bubble that popped with PC disk drives and PCs themselves and so on and so forth, and that gave way to the whole networking explosion. And there's probably another cycle that popped somewhere in the between 87 and 92, depending on how you want to look at it. And then we went on through for another, for the rest of the decade of the 90s, which was arguably the best time in the history of the industry. So I'm going to take an optimistic view here that that where we are right now is in the middle to the beginning of the second half of a cycle when things usually get a lot better than they have. And we went through a very long bad period in the years of the beginning parts of the 2000s, to be very fair. And I'll try to close up with some data that actually shows that. So here are the first factoids, that things you might not know about VC. Well, Ray, you already know this, but 21% of the U.S. GDP in terms of revenue annually is attributable to venture-backed companies, and that is done on an annual venture capital investment amount that's 0.2% of the GDP. So it's a tremendously important return in terms of what's out there in the marketplace, in terms of this revenue and all the jobs that are associated with it, for a very, very small amount of investment. And we'll come back to the issue of what's the right amount we should be investing in it, because it's also, not only is it cyclical, but it's never been argued by anybody that practices this business that it's a scalable business, right? It's a craftsmanship or an artisan game, and pouring more money after a venture opportunity is something that a lot of countries around the world that think they need to get caught up really quickly are learning the hard way. You just can't throw money at a problem and try to build an outstanding venture practice. Second thing, factoid here, is that venture capital-backed companies create jobs at a rate 3 times faster than regular corporations. This is based on NVCA data from 06 to 08. There were 12 million new jobs in 3 years there, averaging 4 million a year. You also mentioned the point already, 92% of the job growth in the industry occurs after these companies go public. Here's one that I bet you don't know. Guess how many jobs have been created in Japan in the last 20 years? 0. Year one of a startup creates 4 times more jobs than any other year for companies that have been in existence anywhere from 1 to 15 years. And this was some more data that was put together by the Kauffman Foundation. I think it's interesting here. I would like to get the first slide going here now, if I can put it up. Where's the advance? I'm sorry, I don't know the Mac. Okay. I'm not going to go through all of this because many of these points were made already, but it isn't just about the quantitative thing. And the only real point that I want to make here is one of the things that the venture industry doesn't get enough credit for is starting these life-changing businesses that are in the middle of this diagram here, associated with our biotech and life sciences industries. And 1 out of every 3 Americans have had their lives improved as a result of products and services coming forth from venture-backed life sciences companies. Let's see if I can advance. Okay, the next thing that I wanted to make, or point that I wanted to make here is that it's a very global business now. We need to keep everything in perspective because the venture industry is not just happening here in Silicon Valley now. We just had our annual meeting yesterday. We had tons and tons of people there, but we've done some immense amount of activity successfully investing over in China. We started about 15 years ago, but even though the numbers of investment here don't look as big, some of the best returns have been coming out of places outside the United States, and you can expect that to pick up steam. This year is probably a distortion here, 2012, for the where I have the data, but China had a lot more invested and raised, I think, in the year or so before this. But it's a growing force, and it's very, very well served financially. And the U.S. and China kind of dwarf, a lot of the other, regions or countries that are documented here on this particular chart. I'm going to come back to this chart here in a second, but I'd like to now go into discussing the, some anecdotal data here, which I think helps set the perspective for, where we are in the overall equation. It's not too hard to find out, but if just go look at the traffic patterns in the Bay Area right now. I don't know whether they're worse or better than they were back in the year 99 and 2000, but my sense is that things are getting pretty crazy and that they're beginning to resemble. So what are the factors for that? Well, I've talked to the CEO of Silicon Valley Bank a couple times in the last 2 weeks, and he said they've opened more new accounts in the first 6 months than they have at any 6 months in their history. Another interesting data point that you might not know about is that this activity is being driven by a huge increase in corporate strategic venture capital coming into the Valley, not just from the U.S., but from China and from the East Coast and from other countries literally all over the world. These governments are saying we got to go, or these big companies are saying we got to go figure out how to be more innovative. And if we don't have some access to or presence in Silicon Valley, we're not going to be successful. Some examples, I'm on the board of DirecTV. We've got an initiative to be more active here in the Valley, but Comcast, Verizon, Tencent from China, and Alibaba, which is looking at the prospects of putting out the world's biggest IPO here very soon. In contrast to what our first speaker said, I believe that the exit environment right now, and I've been studying this for the last 5 or 6 years, is going to be the best one that we've had since the year 2000. We're going to slightly exceed the number of IPOs, but some important unique things are happening here. The biotech industry has been on its ear and out in the frigid cold for God knows how many years in terms of being able to get IPOs done. We're on track right now to have 25 or 30 IPOs for the life sciences industry. I don't know whether you include those in the statistics. It just depends on who you're reading, whether those are included or not. But we've had a pretty significant change for the better here. And one of the things we need to keep in perspective is that the IPO market's health is very much dependent on external macroeconomic factors, as many people here know. And so you couldn't possibly have any IPOs of technology and biotech companies going on in the middle of the global financial crisis because everybody was too afraid. They were putting all their money in cash and running for the sidelines. And so I think that slowly confidence has been building up here. And the Wall Street Journal just a couple of days ago said that as far as the numbers are concerned, they think we could do at least 225 to 230 IPOs this year, which will be more than we did in 2007. Let me make a couple of more observations here, and then I'll start to wrap up. One of the things that I wanted to do also is to discuss take some of the questions that you posed and give you, at least some of my answers on those here. So I would like to deal with those right now. Before I do that, I'll switch to those questions and then come back. I want to make one other additional point here. There's been a right-sizing or a balancing of the venture capital industry that's taking place in the last couple of years. By balance, I mean that 5, 6, 7, 8 years ago, we had far more venture capital committed to funds in the U.S. than we were spending or taking down every year. And we've been working that backlog off for about 6 or 7 years. So sooner or later, when that backlog comes down, we get back into balance. And the thing that creates the distortions in the venture industry is when that balance gets out of whack. And the most extreme example of that was in the year 2000, when I think something like $100 billion was committed, and we really only were able to spend, a very small fraction of that. So this balancing is leading to and the emergence of angels is leading to a phenomenon that's called the Series A squeeze, which is going on in the Valley. I'm not going to spend a lot of time on it, but when entrepreneurs go out and deal with angels, they raise money. And one of the arguments that every professional VC that I know of, including many in this room, always uses is that when you take money from angels, you don't even know if they're going to be around or whether they're going to have any more money for the follow-on. They don't provide you with all the other support and help that you mentioned in your study there. So I feel that that I think this balance is going to come back and help restore an environment in which Series B and C rounds are going to be more readily available, although in the current environment that might well be at high prices. So the next topic here before I wrap up then is the venture industry right-sized or is it too small? It's hard to say. I think you have to ask that question almost on a global basis rather than just on a country basis anymore, but I think it's getting to be right-sized right now. But you could probably argue that it could be slightly larger, and some of these large corporations that are coming here to start up venture activities in the Bay Area are going to cause more funds to be available, although they might not show up in some of the conventional NVCA statistics. Is the IPO process permanently broken? No, I don't think it is. I think that there's been some meaningful progress that came about as a result of the work that we all did on the Jobs Act, Ray. And I think that, the fact that of the numbers that we're seeing out there this year coming public, I think that's proof. But we're going to have to be dealing with different sets of environments. We have new things like secondary markets out there now that help people get liquid and so on. So the next question that you asked was, will other funding options be as effective at creating lasting innovative companies? I think I've touched on that one already. And the implications to society of a smaller venture industry. I don't think that would actually be healthy, and I don't think that's what's going to happen because in our industry, the market has a very interesting way of working. So I'm going to wrap up then on some of the bullet points about why I'm optimistic about the venture asset class here. Talked about the first bullet already. Second bullet, innovation is exploding everywhere you go. When I travel to other countries, people don't necessarily know how to solve the problem, but they surely know that they have one. The IPO window has been opened because of these macro factors, but more importantly, because investors looking for growth have found some outstanding growth opportunities in the new IPO class of the year 2013. So we have this more balanced thing we talked about, and then the venture firms have been fleeing to quality, and the angels are rising. So the last point that I would like to make is where I started, which is I've talked about the cyclical nature of the business, and here is the beginning. I don't care how you can define the beginning or ending of a cycle any way you want, but most people just define the beginning of a new cycle as that right after the last one craters. So if you go over there in the year 2000, you're starting out at the new bottom, you see that the performance of these funds has been stretching along across a period of quite a number of years. the numbers that you put up here just crossed double digits in 2007, but they're nudging their way up nicely, and they're up to over 30% now. So these numbers, it's been a bad period, no question about it, but that is what gives rise to better performance, you know, at the end of the cycle. These forces tend to be self-correcting, and with that, I'll conclude my remarks, and we can have some more discussion later. Thanks.
While they're getting the slides up, I always find it almost comical that everybody has the same data and gets to different conclusions. But that's what makes for a panel, but what makes it entertaining. Chris's research, I think, is the kind of thing that's important for public policy, meaning I think a lot of industries are under pressure in terms of public policy these days. So these kinds of measures that the venture industry actually contributes greatly to society, I think, are important. But I frankly looked at the assignment from a different perspective, that of a long-term limited partner. I think about 1988 is the first time I made an investment as a limited partner. I've made investments as an individual limited partner, as an institutional limited partner, probably all over the world, 50-some funds. And so when you look at it from the perspective of a limited partner, you're really asking one question, and that is, you know, do conditions exist in the industry that will permit the participants in the industry, the venture capitalists, to give you reasonable returns? And I'm going to define what I think are reasonable returns in a minute. And I think the answer to that, by the way, is a resounding yes, which I'll show you. So far as job creation, I kind of look at the cart and the horse differently there. I think if we have an industry that has companies that are producing for investors sustainable, reasonable returns, the jobs will follow. The right number of jobs will follow. Not the kind of jobs that were created in the dot-com boom where everybody thought they were rich for a year. So when I'm kind of looking at the business, I look at these dimensions of the business. This is what I'm going to talk about. I'm going to really take no more than about 5 minutes. I'll give you my conclusion first, and then I want to talk about where my data come from. Let me talk about that now. So I did look at the MBCA data. I did look at venture economics. I'm forced to do that. It's boring the first time. I didn't think you wanted yet a third guy to get up and talk about that. It'd be like getting bored to death. What I did was I went out and talked to more than a dozen practitioners, people, senior venture capitalists who I've known for years, new entrants into the business, people literally starting new firms with no experience. It's hard to believe people would do that, but they are. Angels, seed investors, incubators. I talked to people in the IPO business, investment bankers I respect. So this is, I think Dixon used the term anecdotal. This is all anecdotal, okay? But I'm a firm believer that with respect to this industry in particular, you learn a lot more from putting your ear to the tracks and talking to the practitioners and direct observation than you do through some regression analysis. But I warn you in advance that that's my data set, okay? And then I'm going to talk about the size of the business because I think it's critical, returns, industry structure, which has changed dramatically. Sectors, and I probably won't have time to get to the last bullet, we'll see. Okay, so look, I think the state of the venture capital industry is very good. I think it's sound, and it's funny because my perspective is so different on this because I remember very clearly inheriting massive amounts of unrealized gains in the Stanford portfolio in 2000 that really were unrealizable, meaning if they didn't go to zero, they went close. And I look at that as all being symptomatic of an industry that was grossly overfunded. That was the fundamental problem. And it really, if you think about it, the venture capitalists in the room should feel less guilty. It was the limited partners that created that. Limited partners always chase recent historical returns. And in the late 90s, the returns were unbelievable. The amount of capital got multiplied, and the limited partners got what they deserved, which was a down cycle like none they ever saw. The second thing that happened was venture firms raised funds that were way too big. billion and a half, sometimes $2 billion. There was no sense to that other than they could raise it. Entrepreneurs wasted capital on their business plans. So it's sort of, if you look at it as an ecosystem, I think that whole chain really got way out of whack. And I would argue, and I'm going to argue, that it's back to right size today at just about every level, and I think that's a good thing. So let me start there. Size, I think in terms of macro, when I say macro, dollars raised, $100 billion in 2000, numbers range depending on how you define it, but it's 15 billion to 25 billion a year being raised now. It's still getting smaller. I think that's a good thing. I think about 15, 20 billion is the right number. I also, when I think macro, I think the number of firms at the peak 2000, today 500, that's a misleading number when you really dig into the data. There's about 200 consistent investors in the venture capital business. There's only 140 firms that have raised a new fund in the last 3 years. So this is a much more manageable number, getting back, to balance with what in history we saw a number able to create decent returns. When I think about micro, I think about fund size. So are the venture firms right sized? And I'm really encouraged there. I mean, I think about it in terms of, is the money sized for the specific opportunity? And I'll get to the industry structure in a minute, but you've got incubators that have little bits of money. You've got seed capital people that are raising $25, $50 million funds. You've got even a micro venture category raising 100, 150. The Sandhill Road 128 crowd are back to 400 to 500. Very few people raising billion-dollar funds. I think that's a good thing. And I think people are really being conscientious about sizing their funds to the size of the opportunity. And then on the entrepreneur front, I do think that we have this wave of entrepreneurs, maybe too many. But if you think about what's coming out of the accelerators and the incubators, if you think about the experienced teams, I mean, we've had a lot of success, particularly in this area over the last decade. Google, Facebook, Salesforce, all these companies, and now they're getting mature enough that that sort of middle generation of entrepreneurs is spinning out of there, and they're experienced and they're good. One other thing, when I was at the Stanford Business School, we had Chuck Holloway and Irv Grousbeck, and they co-taught one course on entrepreneurism. Maybe Wolfson remembers that. I went yesterday, one of my colleagues at McCaffery, I said, hey, go to the Stanford website. 33 courses in entrepreneurism. I said, hey, check the others. MIT, 30 to 40. Harvard, 40. Foothill College is teaching entrepreneurship. So I kind of look at this as a culture, not that all those people are going to be successful entrepreneurs, but it creates a culture of risk-taking that I think is really positive, and I see it in my kids and their friends. So I think there's plenty of entrepreneurs. There may be more good entrepreneurs than there are good ideas, but that's okay. I think that's good. Frankly, I think it's good for the country. Returns. Look, it's no different. If you really dig into the data, historically, average venture capital returns have never been better than the stock market. And Dave Swenson wrote his first book in 1997, and he said all these alternative asset classes are the same, whether it's hedge funds or real estate. If you're going to get average returns, you're better off in the stock market. You have to be in the top quartile or top decile, and that's where you're going to get good returns. Now, how do I define that? I go back to basics when I'm looking at returns. Long-term real rates of return in public equity markets are about 6% real. If you get a period of time when it's 7% real, that's great. Roll a long-term rate of inflation on top of that of 3%, not what we have today, 10% nominal rates of return, okay? So I think you have to expect 500 to 1,000 basis points of outperformance in venture capital over what public equities give you for you to be compensated for illiquidity and risk. And it's there. If you look at the top quartile, the top decile, what you'll see today, it goes back and forth, but it's around 600, 800, sometimes as high as 1,000 basis points, depending on what period of time, what endpoints you choose. So I actually think that's a very worthwhile return. It takes you to the high teens, low 20s. These return numbers that you see of 30% aren't going to last, but I think if you can count on high teens, low 20s, I think that's a sustainable rate of return. I think it raises a sustainable rate of capital for a right-size industry. So that sounds good to me, too. The industry structure has changed. I want to get through this quickly because we've all gone too long. It's no longer, you know, when I first started to observe the business, it was a cottage industry, Sand Hill Road, 128. The next thing that happened was you got late-stage players. Well, now it is everything from incubators and accelerators to seed funds, to the institutional venture capitalists, corporates, et cetera. Yes, I think that's a good thing. And I think it's a good thing for two reasons. One, it gives entrepreneurs greater choice. Two, more importantly probably, it gives limited partners a greater choice because it allows limited partners to say, what's my risk appetite? So you can look at that whole continuum and say, I want to build a portfolio of risk that is focused here, and that can relate to the overall risk of my portfolio. So it's a good thing. I also think it's a good thing because it does create these sort of discontinuities as these things evolve. I mean, I think it was Dixon that alluded, there is a Series A crunch. That's a good thing. Because now the incubators and the accelerators are going to start to invest a little less money. And they should. I think they're already waking up to that. They're pretty public about, hey, we created too many companies, there's not enough A, the institutional firms may be moving to B. And then I have conversations with people who say, hey, can we talk to you because we want to raise a almost A fund, right? So I mean, I think the industry's pretty remarkable at being capital efficient and finding ways to invest in that continuum. So I think all of that is good. But it does create discontinuities and extremes, and that's just part of the evolutionary process. Okay, I'm gonna wrap up here. I'm not gonna talk about the usual, I call them the usual suspects, SaaS, mobility, big data, because that gets all the press and all the money. I'm struck by how attractive the life sciences, healthcare, biopharma business is broadly defined. And again, this would be the kind of stuff that Chris would say it's awful, okay? You're down to like 24 firms who consistently invest in this sector. It's unbelievable. I mean, and if you go out and talk to these firms, what you'll find is there's no longer competition. It's back to the old days of syndication. It's tough to put enough capital together to make a business plan work, so they have to work together. I love that kind of stuff. I mean, without the government waking up, it's almost collusion. That's good in this business. Let's work together rather than create too many companies. I am? Good. But so the other thing I like about it, frankly, is that we are in a period where we need innovation in that sector, where I think venture capitalists in particular have been great about devising ways to make business models more capital efficient in that sector. I also like the fact that big pharma is slicing all their R&D. There's got to be innovation. So I think that's a pretty interesting area. At least once a week, I have a young, brilliant venture capitalist who comes into my office and says, we're just not going to be able to raise another fund in the healthcare biopharma. And that's great. I mean, that's really wonderful because, it's going to get to be really a good business for people who don't give up on it. That's it. My conclusions, I think it's right-sized. I think there's a huge pool of talent. Obviously, the industry structure is completely changed, but I think it's a very positive change. Returns aren't any different if you really look at it in a more analytical way, and I think several sectors look good. In Q&A, if anybody's interested in my opinion on generational change as an LP, that's important to us. We want to see that these businesses get stewarded forward in the right way or get restarted by the right people. That's my conclusions.
All right. So this is kind of tough. We've got 15 minutes left, and I'm jettisoning I have no questions. And I encourage no rejoinders. Let's go to you. And if you want to sneak a rejoinder in as your answers, that'll work. Eric.
Thanks. I'd just like to get your view. Anecdotally, it seems to me that the industry has become a little bit more binary, where the LPs are giving more money to the top 5 or 10 firms who arguably have more money than they can profitably deploy, and many of the other VCs seem to be starving for capital. Is that anecdotal observation borne out in the data? And if so, what implications does that have to have kind of, two different dynamics going on within the venture firms?
Well, why don't I say first that I'll confirm the data, and then I'll turn to you for whether that's good. But last year, half the new money went to 10 firms. The other half went to everybody else. So there's no doubt that it's being concentrated in the top tier. And I'll let you comment on whether that's good, bad, or otherwise.
I think that, I think the phenomena, I agree with what the point that you're making. I think it's okay as long as it doesn't get out of control. And if you look at a lot of the data on the, the firm sizes, these firms are, they've learned their lesson, from the bubble of 99, 2000, and they're being fairly disciplined about setting a cap on the amount of money that they'll take. So, yeah, the LPs are trying to get into those funds, but I don't think it's out of control at all yet. Stay tuned.
The two folks in the back. You got two. Yeah.
So Chris and Dixon, I couldn't help but notice that you had very different return numbers. Chris's numbers.
Different time period.
Yeah.
Slice and dice the data. You always pick your windows to make the numbers look the way you want.
Well, Chris, Dixon, I want to invest with you. Your numbers were higher. So one is just a comment. Where do you differentiate from a private equity firm investing in late stage tech versus a VC? Because it seems like, how do you really know if it's a venture firm or a tech firm? I know a private equity firm that has $4 billion in San Francisco, and they primarily do tech, but they don't consider themselves a VC.
Boy, this goes back to the data sources at NBCA.
You just have to, I think you have to go and look at the firms and form your own opinion about that.
Yeah, the repository for a lot of this data is the NBCA annual yearbook and the quarterly updates to that. And that's probably the most consistent one, and that's Thomson Reuters, and that's other sources of that. So
to the NBCA's credit, they are pretty disciplined, as you know, Ray, better than anybody, about not mixing and commingling with private equity.
yeah, Cambridge as well. But the point is valid, which is that the data set you use, as Michael said, is important. Trying to be consistent from period to period is what we're trying to do in these indexes. But nonetheless, you're right. There are other non-venture capital funds that are involved, which don't have easy data to get to them.
Look, the returns data is extremely endpoint sensitive, which is why I look at it the way I described, which is on a forward-looking basis, what would make it worthwhile for me to invest as opposed to what has happened over the last period of time, because that's ridiculously endpoint sensitive. And then I think the second thing is that there are venture firms that are doing private equity deals as well. So as an LP, we don't really care about that because we lump it all into a private equity portfolio, and we're saying, okay, this is primarily venture stage risk, and this is more late stage venture risk, and this is more stabilized company private equity risk, and do we have that balanced? And we're careful when we go through the returns on these individual GPs to understand where they came from. If you're claiming to be a private equity specialist and you had one or two big venture capital hits, looks like you found an acorn under the oak, we don't like that, and et cetera, et cetera. So we're less concerned as an LP about what that public data says. It's much more of a micro-analysis of a manager when we're pouring through the portfolio.
Axel?
Thank you. All three of you referenced the stock market, and I think if there's one difference between VC and other alternative investments, it's my impression anyway that the VC industry is more dependent on the health of the stock market, whereas many other of the alternatives brag at least about diversifying more and so forth. And so my question really is, and you might have different answers on that, if indeed we had a significant correction in the stock market, do you think that would have a major impact on the industry right now, or because of the shift towards M&As, is it more immune, so to speak, to shock waves in the stock market?
This is your macroeconomic point.
I think the memory is pretty short, of what's happened over the last 5 or 6 years, and so I think if there was a serious correction, I think it would flow through to the venture industry pretty quickly.
I mean, recent history tells you every time you get a significant correction in the stock market, people flee high-risk assets.
Yeah.
So I think there's no doubt that would happen. But again, I don't look at the kind of the venture activity that I see today as being any riskier, any more exposed to the stock market than it's been in the past. If anything, I think the experience of having such a long dead period post the financial crisis and the dot-com bubble bursting, I think taught people that they have to be careful about not expecting too much from the stock market.
Stock market returns that don't really appear to be all that sustainable. We're not going to have 20, 30% a year returns every year going forward. Does your outlook on the industry change based on that?
Now,
Just say keep an eye on things pretty quick.
no, look,
Keep it pretty quick.
I think that the way I would answer that question is to say venture capital realizations, venture capital returns and venture capital realizations will go down dramatically if there's a substantial correction in the stock market. But I sort of don't get, I would expect that. It's not the kind of thing that changes my outlook on the business, because if you're investing in venture capital, you better be invested through stock market cycles. You better have a place in your portfolio for highly illiquid investments that you don't need to think about selling when the market is destroyed.
On the flip side, throughout the decade of the first 10 years in this new century or that we're in, 90% of the exits were M&A. And on the positive side of the equation, the big corporate buyers have never been more flush with cash. You have a new wave that's about to come into the U.S., which is waves of Chinese and Asian companies that, like Samsung, they have huge amounts of cash, and they're going to come around and start buying these companies. So that'll be a buffer or an offset to the problem that would be caused by a public market correction of significance.
Okay, let's get some more questions.
Can I make a quick question, by the way? Could you guys address crowdfunding, which I'm sure is going to come up? What's the horizon for crowdfunding? Is that okay? Can I ask?
I think it's a crazy idea.
Okay.
I mean, look, I get called a lot by people starting new businesses saying, I want to come in and tell you, say, well, I'll tell you 5 venture capitalists to call. Don't come talk to me about it. I think the whole concept of pattern recognition in venture capital is one of the big value addeds, meaning, if I'm in the space, I see all the good ideas and all the teams. The idea that somebody over the internet can get an offering and some recommendation from somebody who has seen one out of dozens of opportunities to invest in a space, I think people are going to lose a lot of money on that.
But in their infinite wisdom, the government's protecting everybody because they're only going to let them raise about $2 million max. And if you sign all the paperwork about being accredited, this won't be a big.
Yeah, but
I'm being cynical, as you know.
So that's akin to the lottery then.
Yeah.
So let's let the 2,000 people who can only invest 1,000 lose all their money.
But Obama said if you don't like it, you get your money back. I think it's
Right.
like healthcare.
Let's keep going with questions. We got one here. Got you two.
My question relates to what Dixon was talking about related to the life sciences funds. And it's very sad to see so many, just fade away during that period of time. I'm curious, Mike, do you think that limited partners will come in with that kind of patient capital that those companies need? They're hard to get done and hard to exit, and it's very nice because now there are so many IPOs, it's finally coming to bear. But will people be patient enough to really invest in new managers on the life sciences side?
I think it's probably right-sized where it is today. I don't think we need a lot more limited partner capital coming in. There may be, unfortunately, in a lot of rooms like this that are, forgive me, that have a lot of venture capitalists in it, there may be more venture capitalists who want to do it than who are needed. So it may be that there's still too many life sciences funds. But when I look at the kind of consistent activity and returns, Dixon left out some, it's 40 IPOs in 2013. It's 45% returns as a class and only 6 deals that show any substantive decline. That's pretty impressive data. The biotech indexes.
Didn't have the time. Thank you.
There are 2 biotech indexes, an Amex index and a NASDAQ index, and they're both up between 2 and 2.5 times the S&P 500 since 2008. Now, part of that is they were so depressed, but still, the public market likes this stuff. It likes a certain amount of it. I don't think you could double the amount trying to get sold. And so I don't look at it as there aren't enough firms. All I'm saying is it is a much maligned business, and I'm hard-pressed to find out why.
Right here.
No.
Investments in Silicon Valley. Between 35 and 40% of the recent venture capital has been invested in Silicon Valley. I'm not talking about where the VCs are, I'm talking about where the targets are. That creates a substantial distortion in this room and perhaps amongst the panelists. Can you comment on whether that can or should change? I think Dixon thinks it should go to China. I'm not opposed to that view, but it just persists. It's been that way for a long time.
I'm not sure. I think this market is a fairly efficient market. I mean, one of the things that's happened as a result of globalization, entrepreneurs can start up companies with teams that are spread all around the world, and they do that very, very regularly and consistently right now. And so it kind of doesn't matter that much, at least in an awful lot of startups, where the geographic headquarters of the office is. If the team has a history of working together and they've been able to generate good results, they can work virtually. And that's my answer to the question.
I would say just a short answer is that, per that ecosystem chart we put up, you can do the entrepreneurialism anywhere, but it is easier here. You got all the factors that go into it, from talent to companies to source and everything else. It's easier here, and in tough times it's easier to invest here, but talent is everywhere.
Counterpoint, talent shortages are very, very tight here in the Valley right now and in the city because of all of the activity that you're just describing, and that's becoming a very real concern to management teams. Having very hard times hiring really top-notch talent.
Let me confuse the issue one more time. The name brand venture firm, I'm not going to say the name, told me that in the last 3 years, 90% of their investments have been outside of Northern California. 90%. And then I talked to, I think, the one credible incubator in LA, and they said 90% of their successes, meaning the companies that actually find funding, relocate to Northern California.
That helped a lot, thanks. That helped a lot.
By the way, just to pick up on that, this has been going on for a long time. All the great tech startups in Israel, they almost always have a plan from day one to, once they get the product going, to relocate headquarters to somewhere in the U.S., either East Coast or here, whatever. But that, I just want to remind people of the fact that phenomenon's been going on for a long time.
Sure.
Phil?
Annalise Saxenian wrote a book about why that happens. Everything that you need is here, the best. I had a question for you, Mike. You were mentioning that in the venture industry, if you look at all the firms, they make about the same amount of money as you would in the stock market. And
You take average returns.
average returns.
Average,
And so it's
right.
very important for you to try to get to the top quartile or decile, as
Right.
you said it. When you say it's easier to choose those in the venture industry than in the liquid stock market side, I mean, if you take the top decile or quartile in the stock market, the fact is those money managers change in a big time way every year, no matter whether you choose 5 years, 3 years, 10 years, 20, right? Isn't that true?
It's a very good question. The term we use for that is persistence, meaning it's one thing to say the top quartile outperforms. That's true in every asset class, but is the top quartile composed of the same people time and time again? I think the highest degree of persistence is in venture. I think after that, it's probably private equity. You get very little persistence in the public asset classes, as you suggest. Now, having said that, it's not like you don't get some movement in the top quartile in venture capital. And the other thing I think people need to be careful about is that, when people think about the top quartile, they think about the kind of brand name firms that are, a lot of which are represented here in this room tonight, right? But in fact, now because you have all these segments, we kind of look at it that way now. We want to be in the incubator business. We want to be in the seed capital business. We just want to be with the best people doing that, right? So there is actually, and I don't think a lot of LPs can do that, right? Because they just sort of ask people to point them in the direction of the top quartile, and they all end up knocking on the doors around here. So it is a little different, but I think by and large what you're saying is true.
Hey, listen, we tend to stop on time. I wouldn't want this room to look like that Arizona State Stadium looked at the end on Saturday. So I want to thank the panelists and see you next year.
Thank you. Thank you.
Good. Really enjoyed it. That was terrific.
Very good. That was fun. That was fun. Thanks, Chris. Thank you. Sure.